And then George Floyd happened. And, you know, it gets a little bit personal, but I think about myself as a, you know, as a black man in an industry where there are not a lot of them, certainly not with the funds and the size that we have. And I said to myself, wow, I've been deluding myself, and I don't know what I've done. I don't care what I've done. If the state of relations in this country is this bad, then I'm just not doing enough.
Ollen Douglass is a name that many have come to recognize in the venture industry, in particular for building the first venture fund for the Motley Fool, a popular news and media platform providing investing insights and financial advice to millions of people for over 25 years. But his story takes an unexpected twist as he walks away from a $250 million outfit he helped start. His abrupt departure left industry insiders, including me, hungry for answers. And today, he's here to reveal in his own words what happened and why. And importantly, we'll chat about his mission to challenge the status quo as a black man in this industry. Join me as we peel back the layers on Ollen's journey, his call to action that will leave you re-evaluating everything you thought you knew about VC. So lock in your focus, turn up the volume, and get ready for this week's episode of Billion Dollar Moves. Trust me, you don't want to miss it. Ollen Douglass, this is take two. Ollen, I'm so excited to see you and to have this conversation with you at a very interesting time in your life. First of all, how are you, my friend?
I am doing well, Sarah. Thank you very much for inviting me back to the program. I really I'm grateful for that.
Now, part of this was because you were going through a little bit of a transition, yes. And we'll talk a little bit about you walking away from a $250 million fund called Motley Fool Ventures, which you were a key man of. But let's take a step back. That's a bit of a hint and a teaser for our audience because it gets really good, guys. But Ollen is in front of me, and let's talk about who Ollen Douglass is, you know, Ollen, frame who you are and what brought you to this work.
I'm from Baltimore. I was born and raised at in very much multi-generational Baltimorean and Maryland. My background is in finance. When I graduated from college, I went to KPMG, one of the large accounting firms, specializing in auditing, particularly financial institutions and healthcare industries, and I did some retail. And those are really foundational in threads that kind of continued throughout my career. I've worked in banking and various components there in financial analysis, all of it in the finance side, whether it was financial analysis of corporation, I've worked in fair lending, analyzing data there in kind of the portfolio, derivatives and hedging departments, risk management. So a real background in banking. I joined the Motley Fool in 2001. So it was a very long time ago, 22 years ago. And shortly after that, I was probably there for about 3 years, was promoted to chief financial officer. That's where I spent most of my time at the Fool for about 14 years doing that. And then I was able to launch a venture fund inside of the Motley Fool. That was in 2018, and that was the birth of Motley Fool Ventures.
As you mentioned, starting with the lens of auditing and finance, you know, thinking about risk, how was that transition for you to then go into venture, where you're taking risk every day?
Well, it was extremely helpful, and you know, for anyone who can, you know, work at an accounting firm, it really teaches you how to understand a business from the bottom up and to look at I think what I do is I look at the financials of a company and I see a story, and then I listen to the story that the you know, at the time the CEO is telling me whatever, and I want to make sure those words and those numbers kind of match. And I think that skill set I still use today in venture capital when we're looking at these early stage companies where the financials are really kind of immature. And that's the other thing I really learned at KPMG and then honed was this ability to almost look at the financial statements as the output of the business process. So then once again, I'm looking at these early stage companies, listening to what they do, seeing their key metrics, and I'm able to kind of decide how well the financial statements actually match the story. So that's really pretty good. And that's a great way of managing risk. The more consistency there are, the less likely you're going to run into that. So it's venture capital. We can't get rid of all of this. For an accountant, I'm probably pretty high on the risk-taking scale, which is probably very low on the scale of normal people. But I have a higher risk tolerance than most, and I enjoy that, that little bit of the unknown that kind of comes.
Yeah, love that. And so that little bit of unknown for you was creating a venture fund as well. Can you also give us a sense, we have a global audience here. The Motley Fool, of course, is very popular in the US and increasingly globally. It's been around for years now. But tell us a little bit of, about the business model here and then how you took that retail angle into venture.
They are a financial news and media company. They do have an asset management business as well. But they're primarily what they do is a subscription-based business where they help teach individual investors how to invest. And I would say, Sarah, it was I enjoyed working there. It was very exciting. I think for what I learned, as an investor, is just as valuable as what I learned from being there and working. It's an incredible place, and if there's anyone who is interested in learning how to invest in public companies, I still think the Motley Fool is a great place to go. But for me, when I started to think about the fund and what we would do, what I realized is that these years of the Motley Fool providing investment advice or investment opinions and news on public companies, they had built a philosophy on how to look at those companies. It was a founder, first still a bet on a jockey approach. There were strong business models. And I realized that a lot of the fundamentals of how the Motley Fool looked at investing in public companies could be applied to the private markets as well. And I was able to run a pilot program at the Motley Fool. We had made some private company investments ourselves to work out that thesis. And it turned out that we felt there was an opportunity to take those principles and move them to a larger stage. And then that's, in fact, what we did when we launched Motley Fool Ventures, the first one, our very first fund, first-time fund manager. We ended up going out and raising $150 million, and we did that almost exclusively from the Motley Fool audience. So I come out of the gate with $150 million in 800 investors or LPs in the fund,
geez.
And we're off to, and most funds have anywhere from, who knows, I think the sweet spot is probably 30 to 60 or 70 is what a typical fund would have. Some have one. The max in the most common type of fund, the max is 99. We had a different structure to address that. So coming out with 800 is what I believe is, from a number of investor standpoint, is the largest that anyone has ever done. Mm-hmm.
Yeah, indeed. And in fact, you were jumping on this trend long before it became popular. I just had Jenny Fielding on the show, who has 500 LPs, right? Everywhere Ventures, the fund, it's a community of founders, and they, wanted to back each other, and that became the genesis of it. We've also got different structures of public solicitation, right? Where they're using their Twitter following and so on and so forth to get these communities. But of course, you benefited from the platform, right, of the Motley Fool already building that trust with retail investors. So when you think about doing this very early on, did it take a lot of convincing of the current retail investors to go private, or was there already what you felt was a great interest and pull from your investor base already to do this?
Yeah, no, and you're right. And those were, stepping back, Jessica, those were very conscious decisions to create a different type of fund. We were what's called a 3C7 fund, which allows us to have up to 2,000 investors, but it has more strict requirements for who can get in. And then the general solicitation as well allowed us to market broadly. And both of those things were, some people view them as onerous. They're actually just trade-offs. Like, you have to decide, you're going to exclude some things by doing it, but then you close some doors and open some other doors, and it's really just doing the kind kind of doing the mental math to understand, is the net difference better or worse? And when it came to talking to the individuals, it was a message that I think resonated really well with individual investors. We talked about not just getting into the fund, but we recognized that our audience were people who, well, they had, created some sort of wealth, and most of it was not through kind of the private markets. So venture capital was very opaque, and for some of them, kind of a scary place. And even once you know venture capital, it still can be scary, right? Just to be honest.
Yeah.
But
well, it still is for those of us in it and know it as well.
It scares me too, So what we did is thought about what were we trying to accomplish, and obviously we wanted to make money for our investors. They were entrusting us with their capital, and that's something that we take very seriously. But we decided that wasn't enough to distinguish us, because we all want to make money, but we don't. But what else could we make sure that we're bringing to the table for our investors, and particularly for this universe of individual investors? And what we realized is that there were a couple things that we wanted to achieve. First, make them a ton of money. Second of all, pull back the curtain on venture capital a little bit, so that it's not so mysterious to them, so that the things that they learn could kind of help them to be better investors, or either help the people that they know either understand venture capital and be able to use it, or even understand the lessons that we're learning about business and then be able to apply that. So the goal was, we hope that what you learn, similar to what I said about investing at the Motley Fool, just being an investor, what you learn from being in our fund, you really have to think about what is more valuable, the amount of money you make or the value of the lessons that you learn. And we were very much going to be focused on making sure that we have those honest and frank conversations about how our companies do, and really share the knowledge with it. And then the last one was really aspirational, when you think about creating generational wealth. And I thought, like, how cool would it be that when you're sitting there, Sarah, talking to your child, talking to your grandchild, in that great public company that they invested in, you can sit beside them and say, I invested in them when they were a private company. So that the great public companies of tomorrow are going to be the great private companies that we're investing in today.
Yeah, and that makes sense, right? I mean, at the Milken conference, one of the key highlights on, analyzing the future of the venture markets is that the IPO window is shut. Private companies are staying private a lot longer than before, right? So this becomes a natural strategy for your investors to do this. Do you think that's part of what helped this trend as well?
I think so. I think it's two things. Private companies are staying private longer, and it's getting easier to invest in private companies. Again, with the general solicitation, being able to talk much more broadly about it. Before that, you almost you were kind of pre-screened for your net worth, kind of indirectly, and it was very much a clubby type of dynamic where you had to know the right person to get into a deal. But I think it's a private company staying private longer, technology increasing, and then still just the big opportunity. The largest public companies in the world, you look at the top 10, I believe it's 7 of the top 10 in the U.S. are venture-backed companies. So even though they're staying private longer, there's still a tremendous amount of wealth creation to be had. And venture capital punches above its weight like no other kind of asset class.
This week's recommendation is Make It Happen Monday, hosted by John Barrows, brought to you, of course, by the HubSpot Podcast Network, the audio destination for business professionals. Make It Happen Monday offers actionable sales tips to close more business with insights from industry leaders and, of course, host John Barrows himself as a leading B2B sales trainer and founder of J. Barrows Consulting. An episode that I enjoyed, that I think you will too, is the one with Dr. Howard Dover, the economy, tech, and education triple threat, where Dr. Howard Dover, the sales coach and director of Center of Professional Sales at the University of Texas in Dallas, explains why there's still plenty of opportunity in sales for those who reach out and take it. Dr. Dover believes that rising interest rates, technology, and ineffective education have created a serious problem in the sales profession, but there is still light at the end of the tunnel, thank God. Listen to Make It Happen Monday wherever you get your podcasts. I love this point that you brought about the education process here for investors, because longer term, this, in effect, what we're seeing and what we've been talking about here is the democratization of venture capital, which has been a great source of wealth, particularly in America, that hopefully then carries on to those that don't need to be necessarily accredited in the old school way, or know the right people and being part of the clubs. When you think about sort of the similarities, right, sort of looking at public companies and private companies, what were some of your key lessons there on what were the similarities and what were the differences that you were educating your sort of group of investors about?
I think the most important one is, while we all have portfolios of private stocks, we have portfolio of public stocks. When you're talking about private companies and investing in a fund, you really do have to look at it as a portfolio. And it's going to be the net results that get you the outcome that you want. I mean, everybody thinks about it, but we tend to be much more focused on the individual stocks in our public company portfolios and the ability to buy and sell whenever you want. But the nature of venture is that you're really giving people money to create a basket for you, and it's really the performance of the basket is where you get your returns. But the lessons are on an individual levels, and most of the companies are not going to achieve the financial goals that we want, that we expected, and that is normal for venture capital. And so helping people to just put their, I would say, heads in the right place, as going into that was important. The idea of relationships. If someone decides they want to buy Apple, and they buy Apple. If you want to buy Apple and Microsoft, you don't have to talk to Tim Cook and Satya Nadella. You just go buy it and you sell it. Yeah. Whatever you want. And it's always there for you to buy, and the price is always known. And that's a huge, huge difference in the private markets when you're a private company investor. First of all, you have to be invited to invest in a company. And so there's a big relationship part of that. You either have to have contact with the founder or someone who has close relationship with the founder. There's sensitivities around investing in competitors. The time horizon for getting in is limited, and the time horizon for getting out is unknown, right? And so it's just, it's a different, and then depending on the stage that you invest in, there's a whole different level of analysis and research to come in. We talk about private companies as one huge basket, but there's a tremendous amount of diversity in that. And in fact, if you think about a pre-seed company and a pre-IPO company, it's amazing that they're still in the same category. That pre-IPO company has more in common with a public company than it does a pre-seed company. And so you look at those completely differently, different return expectations.
Yeah. And I love this because, we do have quite a group of LPs that tune in here. How would you speak to an LP who's thinking about diversifying, about broadening and increasing the allocation into venture, and how, you said there's a right way to think about it. What is the right way to think about venture as an asset class?
That is interesting. And I'll give you the same answer I give to retail investors, but the application is a little bit for institutional. There's this asset class called venture capital that, again, you look at that market cap, this little tiny asset class is effectively driving the business economy of the United States, the biggest economy in the world. And you can't not be in that, right? You definitely want to participate in the machine that's creating, wealth for everyone through the businesses themselves, through the products, the services. They're leading the charge into the future, and you kind of have to be a part of that. So how do you do it? The way I look at, particularly managing risk in this environment, is think about your portfolio, think about where you don't have that exposure, and if you see that there is just even conceptual appetite for venture, right size the bet is what I do. I would want to experiment in an asset class with enough money that if it's successful, it makes a difference, right? That you actually move some sort of needle for you. And I think for most people who are unfamiliar with venture capital, that feels like somewhere around that, anywhere from that 3 to maybe even up to 10%, depending. Again, it ranges of it. People who are all into venture can go up to 30-40% in that. But those are folks who are much more experienced. But think about that, just a rough number. Could you put anywhere from, like I said, 3 to 5% into venture, just to kind of experience it? And there's nothing like, there's no substitute for actually being an LP, because there's significant amount of information that's shared internally that's not shared externally. You can't watch it from the outside the stadium. You gotta buy a ticket and get into the arena.
I love that metaphor.
To experience the game. It's kind of like the acting career. There's a small number of people who are at the top of the pyramid that everyone knows about, but it's a really big industry, and that is always there's someone at the very early levels that's going to be that superstar tomorrow.
Yeah.
And if you wait until they're a superstar, it's kind of like trying to get Taylor Swift tickets now. I mean, it's much easier if you were friends with her back in high school than it is if you're standing in line, and being there in the right 5 minutes when it opens up. You just can't get there, right? So you go in there. There are plenty of people out there, like yourself, Sarah, who can help the institutional LPs, help direct those institutional LPs to the right fund for them. And but for the most part, just like investing in public companies, the most important thing is getting started. Your first investment, again, it's going to be a big education, helps to validate that you do have an appetite for this or not, and it's going to be the one that sets you on the path. And that path is where you really get the sustainable long-term returns.
Absolutely. And one of the things that you and I connected on was also the fact that within ventures, an opportunity to invest into your best vision of the future, of which diversity is part of our shared vision of a good future together, right? Tell us a little bit about the opportunity that you see with underrepresented founders and funders here, and how you had used Motley Fool Ventures to be able to execute on this grand vision together.
Thanks for that, Sarah. And within the fund, we talk about geographic and demographic diversity and investing inside and outside the norms. There's a gentleman, Mitch Kapor, and he has a quote. It's backed by some research on patents, but I think it's just like, genius is evenly distributed across zip codes, but access and opportunity are not. And it's this idea that there are a lot of great ideas and great founders that are outside of kind of the epicenters of Silicon Valley, New York City, Boston, and they're out there and they don't have the same access to capital or even the infrastructure that people inside those inside the big three do. And what we found is that if we're willing to take a little bit more time, because they are, in fact, harder to find, but investing in women, investing in founders, basically both inside and outside. So for us, it's a very inclusive approach. The idea is not to necessarily exclude anyone, but to make sure that everyone has that opportunity. And we've found a lot of success in investing in women-led funds and companies, or co-led, and in underrepresented founders, Black and brown, and others. So I was talking to another investor. They talked about the kind of a 2x2 matrix. You succeed and you fail, and it's with a consensus decision, and it's a non-consensus decision. And really, it's just about success. You want to keep shooting for success, and what that means, there's a lot of competition to find success where everyone else is looking. There's much less competition trying to find success where no one else is looking.
Yeah, so talk to us a little bit about the thesis here. I mean, you started with 150 million straight out of the gate, which not many emerging managers, right? Fund 1, Fund 2, Fund 3 have that great privilege to, but you've had the backing of a great brand, a great platform. You decided to sort of invest in a hybrid approach, a little bit of funds and a little bit into directs. Talk to us a little bit about the strategy here, how you were thinking about portfolio construction, and why a hybrid approach.
So that hybrid approach wasn't intentional, and it wasn't even part of the plans, the secondary plans when we launched the fund. We just wanted to go in there. We were committed to inclusion, geographically and demographically, but that was the end of it, and we were serious about that. And then George Floyd happened, and it gets a little bit personal. But as I think about myself as a black man in an industry where there are not a lot of them, certainly not with the funds and the size that we have, and even throughout my career, I've often been in rooms where there's not a lot of representation of black people, and I know that. My goal before George Floyd was, look, I just want to lead my life a certain way. I'll be a positive role model. Not that I wanted to be a role model, but when you stand out, you are whether you want to be or not. And so it's just kind of acknowledging. It's more of an acknowledgement of the reality than some aspiration. Hope that if I could conduct my life in a certain way, as I ran into populations and then people were confronted with stereotypes, they would say, well, I know Ollen, and he's not like that, so maybe everyone's not like that. And so in some small way, I thought that by doing that, I could at least be a small contributor to a larger dynamic. Then you come home in May of 2020, and you turn on the TV, and you see a black man that could be a relative, that could be someone you knew that seemed kind of very familiar, being murdered on the 6 o'clock news. And I came home from walking around from COVID in a mask when we all had too much time to think. And I said to myself, wow, I've been deluding myself. And I don't know what I've done. I don't care what I've done. If the state of relations in this country is this bad, then I'm just not doing enough. I have to do more. It has to be less passive. It has to be more intentional, and it has to be more explicit. I went back to the Motley Fool and kind of looked at our records and our documents, revisit those and realized that within the fund we had a provision that allowed us to invest kind of up to 10% of that fund into other funds or other kind of vehicles. And we gloss over it. There were a lot of challenges in raising the fund. And being very new to the industry, I didn't realize that everyone was struggling. And obviously our outcome was great. And there's a lot that goes into that. But I thought it was just me, because you read Crunchbase and it's just success story after success story, right? And when you don't know, you don't know anyone.
$1 billion fund, unicorns every day. That's right. Yeah.
It's like I was like, in getting to know people in the industry, I realized that there's some really smart people out there. There's some really talented folks who are doing great work that are struggling even more to raise their fund than I was, and that didn't make sense to me. And I started thinking about that, and a lot of them have been so helpful in helping me get up the learning curve in venture. And I said, well, I don't want to wait until Fund 9 to then start to figure out ways to kind of help other ones. I was like, I'm in Fund 1, they're in Fund 1. I've been fortunate, I've been blessed with what I have. What can I do to help them now? And so we decided to take 5% of our fund, create a cohort. I would kind of invest in a cohort of other funds that were led by black and brown founders, or had investment, or led by anyone, but had an investment thesis focused on helping the underserved, right? And again, it's more about getting money into the hands of people who are likely to improve the overall kind of equity in the system. And so we had to, I was very nervous about that, and had to kind of, talk with the team to see if they were on board. They did a tremendous job of helping me to kind of get the right tone of the message.
Yeah.
And then the company, the Motley Fool, was very supportive of it. And so that led us to launch it. We ended up investing in 13 funds. And even within those funds, we were very sensitive to geographic and demographic diversity even within that fund. And so we have a very good mix of women founders, founders inside and outside the epicenters of venture capital.
One of my favorite events of the year is coming up. I'm talking about HubSpot's annual Inbound conference in Boston, and I think you'll love it too. So mark your calendars for September 5th through the 8th, 2023. Catch talks from amazing spotlight talent like Reese Witherspoon, Stephen Bartlett, and Andrew Huberman. And there's so much more, with multiple stages featuring industry experts and tracks from sales strategy to AI and innovation. You'll walk away with practical tips that you can put into action right away. Plus, you'll connect with other leaders from some of the most exciting and innovative companies in the world. This year is going to be unforgettable. Tickets are selling out fast, so head over to inbound.com to get yours today. And Ollen, I mean, I love how you share this. This journey of identity is one that has come up in so many ways with my conversations on Billion Dollar Moves, actually. I think, for people to make that change, a lot of it comes from connecting the personal and the professional. I had, Eric Toda from Meta, who only recently came to his identity of really voicing out against Asian hate, because he thought similarly like you in this country, if not me, if not now, then who and when. But it took a journey. And I wondered, in Eric's, in my conversation with Eric Toda, he actually said in his earlier years, he had avoided this identification as an Asian American because he was more than that. Did you feel that about yourself? Like, because you were like me, like many on the show, unexpected leaders first, and only many rooms that you did not necessarily want to be seen as your racial identity. Is there some part of that?
Yeah, it was a little bit different for me in the sense that I'm a tall person, right? and I stand out in the room, and my racial identity is obvious. The only question that people have about the first impression of me, am I American or am I African, right? But in the sense, and obviously we're all African in the sense, but in the sense of that kind of conversation. So for me, a lot of that journey for me is a very long time ago, even probably as a kid, just I am what I am. This is my racial identity is the starting point for many people, right? And so I had gotten comfortable with that part, but I just wasn't, like you said, comfortable with what it means to really raise your hand and put that stake in the ground that you want to be part of solving a problem. And I think for me, part of that was twofold. One is being comfortable with the role that I wanted to play in kind of promoting racial equity, but also being comfortable that there is no one way to do it, and everyone has to do a little bit of soul searching to find out how they fit into the big puzzle of what we need to do to affect change. And for me, it's important. One of the things, my pet peeves about DIA efforts is often you run into this situation where people want change as long as they don't have to change anything about what they do, right? And
yes.
And I didn't want to, be my pet peeve, and so seeing something and saying, look, I don't like this, and I need to go and make a change. And it's a change that may be uncomfortable, but I know that I'm doing it for the right reasons. I know that it's aligned, and I know that it's part of what I want. And so what I would say to folks out there is think about this, is that if you really want, we have a system in place today that is creating a certain result. I don't know if anyone knows with 100% certainty all the little pieces that are coming together to make the situation what it is. But it's not going to change unless we are open to evaluating all the little pieces that make up the structure today, because in totality, all the problems are embedded in there. We just have to find them. And so think about what you're willing to change. What is it about your criteria to select founders or evaluate them that, as you really ask yourself the tough question, why is this here? And is it in this day and age as important as it was, when someone taught me this 20 years ago? Is it possible that the world has changed in a way where those things are not as important now as they are then? Are there other ways to get to the same answer that aren't as exclusionary? We spend a lot of time in the fund talking about that idea of what we call double click. How can we double click on the common measures of evaluating founders and opportunities?
Yeah. So Olin, what is broken about the venture capital ecosystem today? I mean, what needs to change?
Yeah, I have not figured that answer out in totality, but I do know or believe strongly that venture capital is a relationship business, right? And I don't know if you think about what at the core of venture capital, all the way at the core, there is a founder with an idea and is selling part of their company to someone who is likely a stranger. I don't know how you ever take relationship out of that equation, in order for that to happen, right? Mm-hmm. Suspect that the idea that there's a relationship-driven transaction at the end is really important. It's not going to completely go away. That said, we have to really think about what it means, how we define our network, and what it means to the weight that we put on someone coming to us through our network is something that we need to revisit. How do we broaden our networks? How do we expand them? How do we create situations where we are leveling the playing field and acknowledging what are those criteria that we use that are more valuable than others and less valuable, and it's really a process of changing. Like a perfect example for us is venture capital is kind of extremely overweighted in people that come from a small number of schools, and let's just say, we use like Ivy League school, for example, and that has come to be a marker for success. When we look at that, first of all, it's an idea of congratulations. It takes a lot of work to get that, and having that Ivy League background probably comes with networks and other things that are helpful to you. What we don't do is assume the inverse, which is if you're not, then you can't. And so what we look for are who are the people who have demonstrated a pattern of success throughout their life and are a little less focused on how that pattern of success manifests itself. I mean, when you see it, you see it. Someone comes to you and says, yes, I did not go to college. I started my first business at 12, and and I did this, and I did that, and I did that. And you're like, wow, this person is amazing, right? And you realize that just by, ultimately our goal is to find amazing people. And the more your goal becomes, I want to find amazing people who followed this specific path, the more you're going to run into challenges with diversity and inclusion, because just the nature of most people's paths, even mine, it's a non-standard path. Yeah. And if you're looking for non-standard people that follow a traditional path, you're just creating such a narrow window for people to pass through that you're just not going to be successful.
Absolutely. And one of the sort of pushbacks that people come to me, and I'm sure you as well, with this thesis of underrepresented founders and funders, is that can't just be it, right? Are there enough people? Is there enough pipeline?
Yes, there are plenty of people there. I had a conversation with someone who won't name, and they mentioned that it's interesting. Wow, congratulations on what you've done. It's just weird because I have like over 1,000 connections in LinkedIn, and we looked up and we don't know anyone, and are you in the right places, to get noticed? And I said to him, well, yeah, I did the same that you did, and I noticed that I have over 1,000 connections. You're not in any of my places either. So who is it that has to go to the other one? It's like, I'm sitting here in front of you, so I can demonstrate that I'm trying to get out of my network to meet new people, are you doing the same thing? And that's the question. So I would say the people are out there. It's really a question of your network and the circles, and what are you doing to expand your network to reach these opportunities and these people. And what I do tell folks is that it's really critically important, because as women and people of color are getting noticed a little bit more attention, this is when relationships are being built. And the person who doesn't take the time today to build those relationships are going to find themselves on the outside looking in tomorrow when these things change. So now is the time to get in the game if you want to be in the game 5 years from now.
Tell us a little bit of your success stories, the exits that you've had in your portfolio, and how you thought about this.
Sure, yeah. You mentioned Rana before. We invested in her company. She came to us. It was interesting through an LP that was also a Motley Fool subscriber, and that subscriber bumped into Rana in an airport, and they started having a conversation, random, and they talking. And she mentioned what she was doing, and he said, "Hey, I'm in the fund, Motley Fool. This sounds a lot like what they're looking for." And we kind of got connected. So just kind of, and then we met and just kind of hit it off right away. She's an amazing person, and we were very happy to be able to invest in that.
So Ollen, if I may just double click on this one to use your words here, I remember very clearly the words that Rana said in her challenges fundraising, right? Long before. In the early days, it's 2 women co-founders. She was clearly Muslim. She was wearing a hijab at that point in time, talking about emotion in AI, things that people don't want to talk about. And of course, they came from academia as well, right? MIT. So to many, they were flagged as, this is not a pattern for success that we've seen in the past. And yet they've proven to be successful. For you as an investor, what did you see differently, and why did you write that check eventually?
Yeah. It's interesting because we saw the same data, but came to a different conclusion. We saw the MIT background in, while some people thought academia, we thought subject matter expertise. And in the MIT media labs, where they came from, where their focus was. So this is someone who had training and background that was highly relevant. Rana, if you talk to her, I don't know how anyone could have a conversation with her and not come away knowing that, she knows her stuff. And then for us with emotion AI, we liked that they were very principled in what they do and trying to create this environment where where all of this technology that we're building is being used for good. We loved that as she was building her database of faces, that she was very, very intentional about that being an international database, and that having many people represented in her data. She was clearly very interested in privacy. And so for us, she was a model of responsible technology and invention. And in fact, Affectiva, which is a company, probably was on the edge of our thesis. And so we're investing in tech-enabled companies. They were probably a little bit pre-commercialization for us, but we were so loved what Rana was doing, how she was thinking about the problem, which we thought was unique and novel, and how she was approaching it in a different way. So the things that other people saw that were potentially deterrents were actually positives for us, because we were double clicking on those to see what they mean.
Yeah, and it's a matter of change of perspective, right? A different paradigm. And that's what we're hoping to do here in Billion Dollar Moves, to show that different paradigms are possible. So when you think about sort of your success stories within your portfolio companies, what do you think stands out? Rana, you talked about her subject matter expertise, her drive, and so much of that. What else, when you look at your portfolio companies. What makes a successful founder really make it, especially in this challenging environment?
Yeah, I think it does start with the founder, especially investing in the early stage. Someone who there's something about them that really makes them the right person for the problem they're trying to solve. There's another company called Isuzu that we're invested in, where the background of the founders is complementary to what they do, but really they're in it because of lived experiences and their passion for kind of financial equity. But again, it starts with that founder that when I talk to them, it should be clear that they know more about their product and what they're doing than I do.
Yeah.
I mean, they should be the expert in the room. So we definitely look for that, someone who's passionate. And also, it's really important that they're being driven where the beneficiaries are clearly meant to be more than themselves. That shows up. Most people, not everyone, many people can nail that in their pitch. But what's much harder as we do our due diligence, it's really the type of mindset that shows up in every aspect of the process. So those people who are really focused on a big problem that solves issues for everyone, and they're more they're leading the cause, but it's not about them. Those are the founders that we find are very successful as well, because those are the people that other people want to help.
And so you helped Motley Fool grow a venture firm and now have unexpectedly taken a different turn by leaving a $250 million fund. What happened there, Ollen?
Yeah, well, we closed the first fund for $150 million in 2018. We had a first close of Fund 2, which had a target of $300 million. We had a first close out of $100 million. So that 150 and 100 is the 250 million, and we were in the process of kind of continuing to raise for the second fund. We had long-term plans, or at least I had long-term plans that were fairly consistent. That the first fund was going to be fully retail, the second fund half institution, half retail, third fund mostly retail. And this, so the Motley Fool is a retail brand. They've had a lot of success for a lot of years focusing on that. We dabbled in institutions over the year, but kind of, I think, a little bit born out of the environment that we're in now, where all companies want to focus on their core and what's best, where they can double down and get the highest leverage. Made the decision that across their properties, which includes the venture fund, which is owned by the Motley Fool, and they have other asset management properties, but they decided they wanted to focus on their core, which is the retail investor. And I will say this, as a shareholder of the kind of the big Motley Fool, I don't know if I disagree with the decision. I think it makes sense. I feel like it's within the range of latitude that a CEO should have at the worst case scenario. And so the decision to just kind of focus on retail, I understood why. I've been close enough to know that the efforts that have been made in the past on the institutional side, we were having a little bit different of an experience in the venture fund. But at the end of the day, the company has to do what they think is best for the overall corporation. And sometimes those decisions that are in the best interest of the overall corporation are really painful for some small corners of that corporation. And in this case, the venture fund was one small corner, and this was devastating for us. I mean, it's hard to raise a retail-only venture fund, really, I guess, to the size and scale and have the impact that I had envisioned for the fund. So it kind of left us in a position where, doing what's right for most doesn't mean doing what's right for everyone. And for us, I think there is a way for the venture fund to still be successful under that new mandate. And, they should pursue that. But I was then no longer the right person to run that operation because I just had a different plan. My plan was, different from the beginning.
So you decided this was not for you. So Ollen, I mean, and we were talking earlier about this. This is not unlike my own experience years ago, a chapter ago with, a public listed company where it was no longer core activities, right? And this is, a normal experience, especially during market crunches like this. What would you say, taking a step back now that you've had a little bit of time to think about this, what is the right approach for larger institutions or corporates to actually build a venture fund? Do they, or build venture activities? Does it have to be independent, out of the balance sheet? How should we be thinking about this as management?
Yeah, I've been thinking about that a lot, Sarah. Just the whole corporate VC dynamic. And for us, we were really pushing to be a different kind of corporate VC. And some of the traditional issues that corporate VCs have, we were aware of them and we addressed them. We had external funding, we had full-time employees, we were financial returns focused, we were able to set out strategy, the decisions were internal to the fund. So all those things worked for us, and we had the advantage of being associated with a corporation, which helped us on the brand side and all other ways. So we really thought that we had solved the issue, but corporations still were a little bit nervous about working with Motley Fool. I mean, not LPs, institutional LPs were still a little bit nervous about working with Motley Fool Ventures because they recognized that there were a few important things that were not obvious that were still critical, and it really is the dynamic we're talking about, where at the end of the day, the corporation decides the fate of the fund, right? And that was something that helped me in that decision, is because there were pressures really from both sides. Institutional LPs saying the corporate VC structure makes me a little bit nervous, and then the corporation saying that, the institutions, they make me a little bit nervous, and they both are seeing the same things just from the opposite side. I don't know the real answer. I think about it. It's almost as if I was almost going to say, it's almost like this racial identity kind of conversation we're having before it. Everyone has to get comfortable, to some degree in their own skin, and then operate from there and recognize that, as you make certain decisions, you create certain structures, you're just going to put limitations around yourself. And then I think in that sense, I would applaud Motley Fool Ventures. They've kind of created an ecosystem and an approach that might be sustainable, and it probably has as good a chance as any kind of corporate VC of being sustained, but it's just going to focus on the different people. It's going to play a different role. I wish I had an answer, and I think part of that is why as we separate, we're both going our own directions, but there's no animosity.
So what's next for you, Ollen?
Well, after 22 years at the Fool, I thought it was important to take some time before I really firmly commit to anything. My long-term goal and the thing I'm exploring is, either launching a fund or joining another organization that is ready to kind of continue the work of investing in underrepresented founders, but at that next level of funding where I don't see a lot of people there, and that's in that $250 to $500 million range of funds. There's some in that area. There are very few that are run by underrepresented founders, even fewer who do that with an explicit focus on supporting underrepresented populations.
Very exciting, Ollen, and we will be staying tuned with bated breath. And of course, you're in my pipeline here, so don't forget me in all those opportunities. But let's get to billion-dollar questions. And because this is fresh, I want to ask you something pretty personal, which is in all that kerfuffle, maybe we shouldn't call it kerfuffle, all that transition, what was your biggest learning in that transition with unexpectedly leaving?
Yeah, that's a great question, and I like kerfuffles as a word. That's just awesome. I think for me, it's interesting. One of those things that was a kind of a blessing and a curse. I think that I had so much autonomy and so much support in kind of launching and running the fund that I kind of lost sight of its role in the bigger picture, and so like I rationalize it now, but just not staying in tune to how the venture fund fit into the overall. So like the fund was everything to me, right? But it's a small part of the Motley Fool, and having it be everything to me, in many ways, helped it to have the support it was, because people knew that I really cared about it. There was a lot of kind of cultural alignment, so it was really great. But at the end of the day, I just didn't really keep sight of the fact of that, the primary goal for the fund was, playing a role in the master plan of the entire company, right? And so that led to what should have been obvious being a bit of a surprise, So.
So what keeps you up at night?
Quite honestly, is kind of the future of underrepresented entrepreneurs and where they're going to get funding from today when they're ready for that next level of check, that $5 million, $10 million check, $15 million check. What keeps me up at night is where they're going to get that money from today. Where they're going to get that money from next year. Like there's a short term, there's a whole pipeline of great founders that have benefited from a lot of work in the early stages of investments that are going to be ready for that next level. And there's, unless we believe that the barriers to underrepresented founders that we're seeing in the earliest of stages is the only stage where that exists, and once you get to a Series A or B, all of those problems magically disappear. If you believe that, then there's no problem and all's good. If you don't believe that and you think that these problems are throughout the industry, then it's like we have a giant hole. I talk about the ideas. It's almost as if when you think about this group of founders, we're building a bunch of elementary schools and there are no middle schools.
Yeah.
But kids are about to start graduating, and
right.
Like what happens to them? Right. And
it's the value of death that we see.
Yeah.
Real.
So that's kind of that's what keeps me up at night, is like, can I be part of a solution to keep the successes that a lot of people have taken risk and putting time and money and energy and effort into building? Can we create that bridge to allow those successes to keep going?
A personal flaw that you're working on still?
A personal flaw that I'm working on still is saying no faster and more often. And just really making sure that I'm not taking on more than I should. Even because just because you can do something doesn't mean you should.
Yeah. Biggest insecurity?
Ooh. Not living up to my potential.
And final one for your kids. What are the principles that you want them to live by? Maybe one or two.
I think be nice to their siblings. Don't be last. Listen to your mother.
Very good. Top 3. I love it. And with that, Ollen Douglass, thank you so much for this wide-ranging conversation. We got deep, we got personal, touched on so many elements that I wish we could spend hours on, but we will continue, and we will hopefully come back with part 2 when you're ready with what next. But thank you, Ollen, for all that you're doing, and keep making billion-dollar moves.
All right, thank you, Sarah. It was wonderful talking with you.
And thanks so much for tuning in this week. You can subscribe wherever you get your podcasts and follow our socials on Sarah Chen Global to get the latest on the show. It would really help me out too if you enjoyed this to rate and review our show on Apple Podcasts and share your favorite episodes with a friend. I'm Sarah Chen-Spellings, and you've been listening to Billion Dollar Moves.